you have your left tail downside risk, which come from the virus proliferating and partial shutdowns having to be reinstated. On the other hand, you have your right tail risk. The upside case is the vaccine, and you saw some news on potential candidate for that today. Right in the middle of those two tail risks is an early cycle economy where you have an alignment of growth that's been extremely brisk in May and June, as well as policy support, both fiscal and monetary, that has been robust, and at least in the case of monetary, very persistent in our view. And so, viewed through that lens, today was a very indicative day. Equities and credit go up, the dollar moves sideways, treasury yields are basically pinned where they are. That, I think, is an okay forecast for what's going to happen over the next few months. Today, it was the right tail risk pushing things up, but that's the gravitational pull of that early cycle fundamental and where it's going to push the economy.
Sure. Good morning, Ben. Thank you for joining in this conversation. Where will that early cycle recovery take us into quarter three as far as growth is concerned, as far as earnings are concerned, because you also need to take on board the rising risk of a second wave and potentially a third wave. And so how does that get priced in?
So I think there's almost an inevitable V shape in the data. And so if you're just given the really low levels that we're talking about in the second quarter here, and we're looking at, it's a consumer-based shock in the U.S. Growth on an annualized basis is going to be a negative 40 in the second quarter. And so coming off of those levels, even if you get a bit of a leveling off in terms of the growth momentum, it's really tough for GDP to be anything less than 20% on an annualized basis for the third quarter. And so, that just in some mechanical sense, and given what we've already seen in terms of the growth over the last couple of months, that's going to be a positive driver there. I think the risk is that, some of those bounce backs in the hardest hit sectors are starting to slow. And you're seeing that in an array of alternative data and real-time data. Some of the mobility statistics are not recovering as quickly as they used to. Jobless claims for the U.S. Are improving, but not at the same rate that they used to. And so that second derivative has turned a negative. And even if it's not going to affect the headline GDP number, that might be sort of an implicit, issue for sentiment, insofar as it feels less good when things are decelerating versus accelerating. But that's more of our alternative scenario. As I mentioned, our baseline is one in which that early cycle economy continues to chug along and propel markets over the next quarter.